Hello and welcome to this week's presentation from Hendricks Wealth and Estate Management. The topic for this week is settlements, inheritance, and windfalls. Choosing the right financial advisor is critical. I am your host. My name is Sean Hendricks. I am a financial advisor and attorney at Hendricks Wealth and Estate Management. My credentials are right there. You've probably seen them before if you've attended these, but I am actually an attorney. I am actually a financial advisor. And I wanted to take a quick minute to say happy birthday to America since we just celebrated the 4th of July. So, to get into the topic of settlements, inheritance, and windfalls, most people understand that a financial advisor can be a huge help for planning for retirement. There are other important life events, though. To think of a financial advisor as just a retirement planner isn't everything we do. In this presentation, we're going to talk about some of the things that are important that we can help with that aren't just focused on retirement. And retirement's still part of the picture, but today we're going to talk about settlements, inheritance, and windfalls as part of that picture. So before I go too far down that road, I'd like to spend a minute or two talking about just the definitions of each of these terms. What do I mean when I use those terms? The first is, and these are my definitions, by the way, these are not dictionary definitions, but anytime I refer to a settlement, I'm going to be referring to the proceeds from the resolution of any type of litigation. Now, whether that's an actual negotiated settlement, whether it's the proceeds of a trial, the settlement is the proceeds from litigation. I'm going to use the term inheritance. And when I use that term, I mean assets that are received by an heir or beneficiary of a person who passed away. So anytime you receive something from somebody who passed away, we will be talking about an inheritance. And then finally, a windfall, which is a sort of a catch-all provision or a term, but it's a sudden and significant financial gain, like a work bonus, the sale of a home or a business, or winning the lottery. On average, the recipient of a large lump sum will deplete it within 3 to 5 years, and sometimes it's even faster. So the purpose of this presentation is to discuss strategies that can help you avoid becoming part of that statistic. And when I talk about that and that statistic, most folks are at least familiar with this cautionary tale. You've heard stories about the poor lottery winner. The poor lottery winner is someone who gets a windfall, right? They win the lottery, they've got millions and millions of dollars, and within a couple of years they're broke. They've spent all the money, and now they've become this kind of like this person that we almost feel sorry for. But in each of these, poor lottery winner scenarios, there are a few things that they do, right? Splurge spending is almost always an element where the person wins the lotto and all of a sudden they're the big mansion, the fancy cars, flashy clothes. They're burning through money real fast. Another element that's pretty common in these stories is what I call you're the bank, where once people find out that you've had this windfall, sometimes they mean well, right? But you become the bank for friends and family. They want you to participate in these business ideas or these investment opportunities, which sometimes are very questionable. And they may not mean harm by doing this. They may believe in their heart that this is something that's going to benefit you and them, but they're not typically well thought out. And a lot of times businesses fail. So you're the bank is anytime anyone who finds out about your windfall, they come to you and they want to use their relationship with you as a means of furthering their own gains. And this next one goes along with splurge spending, but I call it lifestyle creep, where all this expensive stuff that you buy, it's not always just a one-time expense, right? That becomes your new standard. Now only expensive stuff will do, and expensive stuff is expensive. Furthermore, there's a lot of things about that expensive lifestyle, like that mansion has a big tax bill and upkeep. That fancy car costs a lot more to insure and a lot more to maintain. And then as soon as it's got more than a few miles on it, chances are you want to buy a new one. So that lifestyle creep is a killer in this category. And then finally, the fourth common element is depletion, where people are spending they're spending their proceeds from this windfall faster than they can grow it. And so you end up in this cycle of depletion until you're eventually broke. So that's where the right financial advisor can come in. And this part is critical because if you want to avoid being the cautionary tale, you have to get someone to help you, right? You need someone to be that voice on your shoulder telling you, hey, be careful, do this, don't do that. And that's what a financial advisor can do for you. So a fiduciary financial advisor can help you make a plan to think about right now and the future. And most importantly, they can help you stick to it, right? They can make a plan for making sure that that windfall can last for the rest of your life, not just right now. Okay. And so a financial advisor who's experienced in advising clients with significant lump sums will help you plan for the big purchases, avoid your cousin's pyramid scheme, and make sure that your future expenses don't trap you into that cycle of depletion. So the first category I'm going to talk about is settlements. And if you've ever been part of a lawsuit, right, you probably know that the lawsuit process takes a long time, right? The settlement or the resolution of the litigation is ultimately intended to compensate you for the rest of your life, not just for right now. So thankfully, we happen to be very experienced in helping people plan for a lifetime. It's what we do. We want to be your lifetime financial partner. So for settlement planning, I've made a list of tips that I'd like to give to anyone who receives a settlement. And number one is don't buy anything immediately. Hire a financial advisor, right? The time to start planning is day one. So don't buy anything, hire a financial advisor. And I would also add in this category, don't tell a bunch of people. It's probably confidential anyway, but if you tell a bunch of people, then all of it, those are the same people who are going to be hitting you up for money later. So don't tell anyone, don't buy anything, hire a financial advisor. Second is to figure out your standard of living. Not just your current standard of living, but include your awards. So what will your award support for the rest of your life? How much can you afford to live on and how much can you afford to spend while having that settlement help you live the rest of your life? The third item is to plan for future costs. And when I say future costs, I'm saying things that you're probably going to need down the road, right? How to make up for any lost income. If there are any specific expenditures related to your injury, and we have to incorporate that, let's make sure that we have a plan for compensating for that for the rest of your life. Then we want to invest in a risk-appropriate way, right? We want to make sure that we're investing in a way that will help your settlement grow over time, but also we want to make sure that we're not being too risky with funds that we might need in the immediate future. Then we want to start a series of planned distributions from your nest egg, right, from your investments. And part of that would be to get rid of any high interest debt that you might have, but then also making sure that the controlled and planned distributions over time are able to support your standard of living without sacrificing the future security of burning through your settlement too quickly. In those investments, we generally want to be tax smart, right? And here we like to talk about being tax smart, but not necessarily tax driven. So your settlement might be paid to you tax free, meaning you don't owe any taxes on it. It's not taxed as income, but that doesn't mean that it's tax free forever. Meaning once you invest that money, if your money is making money for you, you may have to consider things like capital gains, and we can help you plan for that as well. And then finally, once we have the plan all set up, we want to think about the future, right? We want to make sure that your estate plan or any legacies that you want to leave are considered. And we can help you do all those things, and we can and do help people do all those things. And that's the importance of working with a financial advisor when you receive any type of settlement. And now I like to include examples of some things that we've done. So for the example with helping a client with a settlement, so we recently had a client with a very significant settlement that they received as the result of a very serious injury, right? Now, because that person had an injury, the proceeds of the settlement, we needed to do some things right away, right? They needed some improvements to their home to make the home more accessible. They needed a vehicle that was accessible so that they were able to get around more easily. So we planned those things in right away. Once those things were accounted for, then we built a plan based upon their standard of living. So we took the amount of the settlement, we figured out how much they could spend each year and still be able to live, at least an actuarial life expectancy. And so we set up monthly distributions that would preserve the principle of the settlement, at least, in a way that's reasonably planned to last the rest of their life. And part of this was coaching them to avoid being the bank, meaning not to let them, not every drink isn't on them, so to speak, where friends and family members know that they're living in this kind of structured way and that they weren't going to be available to help out with every little thing that every family member came up with. And then we invested the proceeds in a way that was risk appropriate and diversified. The plan was based on their life expectancy with a legacy for their children, and we've considered tax efficiency as part of those investments as well. Finally, we got them set up with an estate plan and a trust so that their assets will pass on to their spouse or their children if they pass away. So the settlement, there's a lot more to it than just, oh, I got this pile of money. It's saying, hey, okay, I've got this, great, what do I do now? And that's the question that we help to answer. The second topic is when you receive an inheritance. So an inheritance can take a lot of forms, right? When somebody passes away, it can be tangible things like a home or a car. It can be intangible things like an IRA or a Roth IRA or a bank account or a trust account. So it can be a lot to handle. More importantly, different assets can have different tax consequences for the recipient. So a financial advisor can really help to make a plan for incorporating these inherited assets into the overall plan for the beneficiary. So I've compiled a list of tips for inheritance planning, and at least this first one's going to sound familiar. Don't buy anything. Hire a financial advisor. Don't necessarily tell people that you've received an inheritance, because again, the more people you tell, the more people might treat you differently. Once you have the assets and you understand that, okay, here's what I'm inheriting, talk to a financial advisor about the different rules associated with those different types of assets. Because inherited IRAs, both Roth IRAs and traditional IRAs, can have some rules that have to be followed with respect to the Secure Act. Certain other types of inherited assets can receive what's called a step-up in basis. And a financial advisor can really help you figure out how to incorporate those different types of assets into your long-term plan. Which leads us right into the next step, which is make a plan. So get rid of high interest debt and invest, right? We want to make sure that we incorporate those new assets into your plan, right? Because just because someone who held the assets during their lifetime had them invested a certain way, that might not be your way. And so getting those assets into your hands and investing them in a way that makes sense for you becomes the next important step. And generally, if you inherit a Roth IRA, that's great. It's tax-free, so we may want to let it grow tax-free. With a traditional IRA, if you have to take some amount out over time, we might want to set up a plan to make sure that if that income is taxable to you, that we're doing that in a strategic way over the course of the lifespan of the asset. And then with assets that get a step up in basis, maybe we want to invest those, but then consider the effect of capital gains on those assets in the future. And it can be a lot of moving parts, but a financial advisor can help you make that plan and then invest it the right way for you. So as an example of an inheritance, we had a client with significant assets who passed away. We worked with each of the individual family members to help them make a plan that was right for them, that addressed their current and future needs. So each beneficiary then got their own financial plan, right? So some of them had high interest debt, some of them didn't. We then invested the proceeds for each of them based on where they were in their lives. For each asset type that they inherited, we made plans for how to use or invest those asset types based on the rules associated with each type. So for example, inherited Roth IRAs, we were going to hold those for 10 years, right? We were going to continue to get that tax-free growth that we were able to get. For the inherited traditional IRAs, we set up schedules to withdraw them based on the anticipated income, the anticipated taxable income for each beneficiary. We incorporated those assets into each of the beneficiaries' own long-term plans, and then we made sure that each of those beneficiaries did legacy planning of their own. I was surprised to see how many of the people who inherited things didn't have plans of their own, and we said, well, if this process worked well for you, you're receiving this because somebody did some planning, so let's make sure we have that same planning done for you. The next category that we're going to talk about today is windfalls. And windfalls is kind of a catch-all, right? So settlements and inheritance can be considered windfalls as well, right? But what I'm talking about here is any type of financial gain, a sudden and significant financial gain, that doesn't include a settlement or an inheritance. And so what do I mean by that? Well, a lot of times, at least ones that we see, are downsizing a home, right? Where someone sells their home, takes the equity out of the home, and they might buy a new home, but they might have a lump sum left over that they want to invest, or a sale of a business or a big work bonus. In these examples, it might not just be retirement planning. That's certainly part of the picture, but they might need more than just standard retirement planning with respect to those assets. And so my tips when it comes to windfalls are, and again, this might sound familiar, don't buy anything immediately. Hire a financial advisor. Don't necessarily tell anyone. You don't want to get hit up for money, and you want to make sure that you start making plans and good decisions right away. For certain types of assets, you may owe some taxes, right? You might have some capital gains that you're going to have to pay. So we might want to figure out from the proceeds of the windfall, are we going to set some of this aside for taxes? Do we even need to do that? If you have high interest debt, we're probably going to want to attack that. And then we want to include the proceeds, like the net proceeds, to you as part of a new financial plan. And then finally, we might want to, if you don't already have one, you might already want to consider setting up a trust or legacy planning to cover that windfall for your family. So an example of a windfall where we helped a client is we had some clients who sold a vacation home after their kids grew up. They just weren't using it anymore. Now, the vacation home was not their primary residence, so they did have some capital gains that we had to consider. But then once the sale was complete, they had a lump sum remaining, kind of the net amount that we were going to have to figure out what to do with it. So these clients had a small amount of high interest debt, so we helped them get rid of it. Since these clients were really, really close to retirement, we plan to increase their contributions to their employer plans, which gave them a little bit of a tax break. They were in kind of a high tax bracket. So we got them a little bit of a tax break on some of their current income while they were in the higher tax bracket. That tax break that they got in the present was a benefit, and then they had some funds remaining that we invested into a brokerage account for them. We then, once the brokerage account was set up and we got a trust set up, we retitled their brokerage account into the name of their trust. So that was kind of tying up the loose ends on their windfall. So in summary, settlements, inheritances, and windfalls can be life-changing events. But without a plan, these events can also become a huge lost opportunity. You need an advisor who really understands the different strategies and the different treatment of those types of assets, and who can help you avoid the common pitfalls. We don't want you to become a statistic. Too many people get bad advice, or they may not have the experience to really maximize the opportunity to improve their whole life instead of just having a really big party for the next 2 years, which that's the cautionary tale. So that's why we want to be your lifetime financial partner. We aren't just thinking about right now. We're helping you think about what you need immediately and what you need in the future. Looking ahead, we are going to have another couple of presentations in the coming weeks. A week from today, Dan, my colleague, is going to be talking about Trump accounts. And then a week later, my colleague Tom Anderson will be presenting about how the SAVE plan is ending for student loans. If there are any questions, please feel free to reach out to us at any of the means listed below. You can either call us, go to our website, email us at info@hendrickswealth.com, or you can message us through Facebook. And if there are any questions, I don't see that there are any that came through the presentation. So we'll give it another 10 seconds or so. But if we don't have any questions, then I will move on and say thank you for watching this presentation. Again, if you're for folks who want to reach out to us, you can email info@hendrickswealth.com. Our Illinois and Florida phone numbers are listed. And if you enjoyed this presentation and you'd like to attend any future ones, you can register www.hendrickswealth.com/events, or you can see some recordings of past events. Other than that, I don't have anything else. Jim or Dan, if either of you have anything to add, that's what I had for the presentation today. You guys have anything to add? Or are we all good?
No, it was very good. And you covered all the upcoming webinars and where to find previous webinars. So you handled it all. Very well done.
All right. Well, thank you, Jim. All right, then we're going to get going for today. But again, if you have any questions, please reach out to us. We're happy to help in any way we can. We will look forward to hearing from you. Thank you very much. Bye bye.
Take care, everyone.